All right, let's kickstart the first conversation of the day. And there are several mutual fund schemes out there, several options available to you as an investor. And some of them are very specialized products. They're meant to achieve a few very key things. But these products, while they offer you the potential for much higher return, or they give you an alpha over almost everything else, certainly the benchmark, there is also a significant amount of risk associated with them. There are products both in the fixed income category as well as the equity category. Joining me to talk about this in more detail is Santosh Navlani, the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time. You've identified a few, and I'm going to enumerate them for my viewers before we kickstart. The first one that you've said you want to talk about is thematic or sector funds. The second is multicap. The third is you have credit risk funds on the fixed income side, and there's also long duration funds. But let's start with the first one, which has to do with thematic or essentially sectoral funds. These are two different funds, first of all. Let's talk about what they are and why is it that you're saying investors should be wary of them?
Hey, Alex. Yeah, thanks for having me here. So I believe when it comes to mutual funds, there is problem of plenty for a lot of retail investors. And instead of understanding the 36 odd categories that we have, like I think we have 11 in mutual equity mutual funds, 16 in debt mutual funds, about 6 odd in hybrid, and maybe about more than a few across solution-oriented index, fund of fund, and things like that. I think what is important is to what kind of categories to stay away from is how we like to approach this session. And one of the areas that we should probably, or one of the categories which we should be staying away from, is like sectoral funds or thematic funds. And at many times people don't understand the difference between the two. A thematic fund is not necessarily a sector fund, and sector fund is not necessarily a thematic fund. So we can probably understand both these by examples. So thematic is a category which actually invests in a theme or an investment theme which is emerging in the marketplaces, a kind of emerging kind of ideology of investment, or some kind of opportunity which exists in the marketplace that people want to benefit from, or fund managers believe that people can benefit from. So a thematic can be like, I am focused on companies which use technology and apply technology in a very disruptive way to kind of create a lot of competitive advantage for themselves in the marketplace and win market share. So one of them globally is NASDAQ, where India has a set of funds available which actually invest into NASDAQ companies in that proportion and almost run like an index fund on NASDAQ. This is basically a set of companies where almost 45% of the weightage goes towards technologies and sector, and the rest falls into companies which actually using technology as a play for themselves. And sometimes these kind of themes work, sometimes they don't, while NASDAQ is an exception which has worked for over a decade or so with stellar returns. But we are all witnessing right now what is happening in NASDAQ for last entire calendar year 2022 per se. It is almost down by 32% from its peak as we speak. And if people have actually had invested in NASDAQ in 2021, chances are very high that they will be sitting in losses today. So it's not about the timing there, but the fact is you need to not just know what's the right time to invest or back a theme. You also need to know when to get out of that theme as well. And that also brings us to another set of category we should be staying away from, is sectoral funds. A lot of people actually invest in recent winners or winners of last 1 year without knowing that they are actually a sector fund. So if you were investing in 2021, chances are very high that you would have seen a thematic play like a IT category fund, or a digital India kind of fund, or NASDAQ for that matter, or any kind of technology which is a technology kind of sector fund is investing in global technology companies. So these kind of sector-specific funds which actually invest only in technology, or only on pharma, or only on say banking, you need to know again when to get in and when to get out. And one of the reasons a lot of people should invest in mutual funds is because they don't know how to manage their money, what kind of sectoral calls to take, what kind of bottom up stocks picking they should be doing. And there's a need, they need a fund manager. The moment you are actually buying a sector fund, that means you actually are doing a fund manager's job, where you're saying that I need a lot of my money investing into specific sector, and that's where things can falter for you. So if you look at pharma or healthcare as a category, if you look at the returns of 2000, I think 15 or 16 or 17, they were not in one of the calendar years, almost like a negative set of returns because of a lot of US FDA issues happened. And again, if you look at post-COVID or in 2020, 2021, pharma became like the biggest sector to be investing in, and a lot of people made money in that. But then whether 2022 is going to be a year of like 2021 and 2020, or going to be like 17, 18 and kind of year, that time will tell. But again, you are banking upon the fact that you can time your exit when the things go bad for pharma, or things come to normal business as usual kind of things. Similarly applies for banking. If you look at how banking sector funds actually perform in the country today, banking as a sector is laggard, completely been laggard on the Nifty itself, and returns have not been good. So if you are basically putting money in a specific sector fund like banking, you may be actually up for underperformance in your portfolio just because you took a banking sector call. So thematic and sector are two categories retail investors should stay away from, unless they actually have a very strong belief that they can profit from it by investing in very short period of time. They would know when to time the entry, they would know when to time the exit and make a quick buck from it. Then of course go ahead and do it. But in our opinion, most people or even most evolved investor cannot do this really, really well. So better to stay away from him, and rather than invest in a good diversified fund where a fund manager would know when to hike up the exposure to a specific sector or a theme that he or she can actually build on its own inside the fund itself, rather than actually chasing a different fund for it.
Thing to mention, and you've talked about this, but I want to stress it even further, Santosh, is concentration risk, right? So in a situation where you have the dot-com bust, or you have a situation where healthcare is finally, and hopefully we can say that COVID-19 is behind us, but once we can actually say with confidence that COVID-19 is behind us, chances are that healthcare won't have the same flavor as it had over the course of the last couple of years. So would you say that buying the index gives you a bit of a taste of everything, kind of, and you don't have concentration risk when you invest that way? And in any case, when people talk about these thematic funds, they're talking about a kicker, right? They're talking about it in your satellite portion of your equity portfolio. So is the primary issue concentration risk?
I want to know that kind of, Alex, because if you look at Nifty, I think the weightage for healthcare or pharma sector is about 5 to 6 percentage points, if I remember correctly when I saw it last. So you basically, when you invest in a Nifty index fund, if you believe that 5 or 6 percentage point is a lesser allocation to that sector, then it's a reverse problem when you're investing in a diversified fund. But when you are actually taking a sector bet and you are saying that I would actually invest 10% of my monthly SIPs into healthcare, and an actively managed fund or maybe an index fund maybe having about 5 to 8% in healthcare, then you actually are taking overexposure to sector fund compared to what you should. So I wouldn't know whether a sector like a pharma can create a concentration risk in your portfolio, but maybe a banking sector may. So banking itself is about, I think, late 30s, depending on the day when we look at, maybe 37, 38%, 40% allocation in Nifty as an index is to banking and financial services companies. And if you on top of it, and most fund managers actually manage funds, actually have good 25 to 30% allocation to banking sector. And then on top of it, when you're buying a sectoral fund in banking, you actually are taking a concentration risk. So if it depends which kind of sector you're buying. If you're buying a banking sector, maybe you'll increase concentration risk in the portfolio, but may not be in other sectors which actually have a lesser weightage in the broader indices. I think it's more about getting the timing wrong. So if you are already having 6% exposure to a specific sector, and you double your exposure by putting money into a sector fund, you wouldn't know whether this is the right way to manage your money. Is the bigger concern that I have than actually getting concentration risk by buying a sector fund.
Point. The next one we've kind of spoken about, if I'm not mistaken, in an earlier episode, we've spoken about multi-cap versus flexi cap. But let's, address it again. Why is multi-cap something to be wary of? I guess it is because of the new definition of multi-cap, right?
Yeah, so if you look at it, what is the definition of multi-cap today? The definition of multi-cap is you need to have at least 25% allocation to all parts of market caps: large cap, mid cap, and small cap. And if you now dissect it further, you would realize that 50% of your money, by definition, is always going to be in large and mid cap stocks. Now, maybe one can say that having a 25% allocation to mid cap over a long period of time, when you're building a portfolio for your extremely big life goals like retirement or children's education, then maybe you would take that kind of exposure to mid cap. But having 25% allocation to small cap in your portfolio is something which I believe that many people would not be comfortable with. If I were to say that you construct an SIP portfolio and allocate 25% of money always to small cap funds, may not be right way, because small cap by history has proven to perform in secular bull run extremely well, but the index typically becomes a laggard or gets a beating in tougher market situations, which sometimes can come in and ensure that the small cap companies actually have a unfair kind of marketplace treatment because of inflation being high and interest is being high, or generally the reforms or the taxation like GST, which actually is harsher on smaller companies than bigger companies because of the way the business is conducted. So I'm not sure how many people will be comfortable putting 25% allocation at all times into small cap stocks. Is how we should be looking at whether multi-cap by definition makes any sense in one's portfolio. And I think a retail investor is far better off by giving money to a flexi cap fund manager if at all he believes in active fund management, because the fund manager would be able to hike up the exposure of small cap from probably 10 to 12% to 20% if and when the market situation demands and a return opportunity is presented. So I would say that outsource the market cap allocation job to the fund manager if you believe in active management. But buying a multi-cap fund which actually ensures that 25% allocation at all times small cap becomes way too risky, because small cap actually has higher volatility and lesser return. The risk adjusted return of small cap index will not be very, very big compared to a mid cap, and similarly a mid cap would not be very, very big compared to large cap. I believe that a right allocation is having like a big portion of money towards large cap, some amount of money towards mid cap, and very small amount of money towards small cap if you are a long-term investor, than actually having this kind of hard-coded numbers in your head.
More schemes to focus on. This one is on the fixed income side, and very fair points that you've raised on both the thematic and sector funds as well as multi-cap funds. Let's move on to the credit risk funds, a much maligned category in the fixed income space. Some would say for good reason, Santosh. What is there, if there is at all, a category of investor that will be okay with it? What should they bear in mind before they put money into a credit risk fund?
So the biggest thing that you need to know as an investor before putting money in credit risk fund, Alex, is you are actually lending money to companies which your bank would not lend to easily. So to put into practice, it's like as retail investors, when we also act as borrowers, when we apply for a car loan or a home loan or a personal loan or a credit card, we get exposed something called its credit score for ourselves, and we all know that how important it is to maintain credit score, and we know that if your credit score falls to a certain threshold, below that certain threshold, we would actually be not getting a loan easily, or if at all we'll be getting a loan, it may not be on best terms. If that applies to retail life, that we stay as a spend as an investor in real life, the same applies to companies as well. So if you are saying that a bank is basically not willing to lend money to a company, I would go and lend that money without a due diligence, and I will rely on the due diligence of fund manager. So ultimately, a fund manager say that I need to price that risk, and I will charge a higher interest rate for this money which I'm lending to the corporate, and in hope that the company will not default and pay me the interest rate. Now, if things go wrong on that side, if the company defaults, you actually are taking bigger risk than equity in your portfolio, because when the money doesn't come, the entire money doesn't come, or the entire interest or the return that is supposed to come will not come. In equity, at best, your value will be down. So, in my opinion, credit risk funds can prove to be far bigger risk than equity funds if you are not sure about what kind of companies the fund manager is lending money to. And we have seen the episode happening in the marketplace over last 2.5 years with a set of Franklin Templeton funds or a couple of other funds as well, where some kind of carve out happens from the fund, and when a redemption gets blocked and things like that. So we also need to be clear about objective over when putting money in debt fund. We put money in debt fund for safety of capital and some kind of interest on it in form of return which NAV generates or mark to market gains generate. Now when I'm putting money in a credit risk fund, I'm actually not expecting return of principal. I'm expecting return on principal. And I believe that this is a wrong way to look at it. I think debt is about return of principal is much more important than return on principal. And if you remember that, you'll be far better off by investing in right set of debt funds and let equity do the job of wealth creation for yourself than trying to create wealth from debt funds.
The last one that we have to talk about is particularly pertinent in the current context, right? You've had a 40 basis point increase in the policy rates and the potential for another percentage point over the course of the rest of the financial year. With rising interest rates, long-term bonds are less attractive because of the way yields and price moves. So therefore, this category that you've highlighted, long duration bonds, long duration funds rather, why is this something to be wary of?
So what happens, Alex, is when the interest in the economy move up and down, the debt papers which are traded in the marketplace, the quoted price for them also moves up and down. Only difference is the bond prices and the interest has an inverse relationship. So if the interest rates in the economy go up, typically bond prices correct to that extent and go down. And if you're basically holding money in a long duration bond paper or a long duration fund, you would see a very high impact or correlation in your portfolio than when you're holding a short duration paper. So there is a rule of thumb, like there is something called as modified duration of a fund. And if a modified duration of a fund is, say, for example, 2 years, and interest in the economy gets up by 1 percentage point, typically you'll see the fund having a correction in the NAV almost to the tune of 2%, and vice versa. So you basically should be focused on funds which actually have a modified duration towards lower end, like a 2-year, 3-year, 4-year kind of at max, rather than actually putting your money in a high duration a kind of fund where the modified duration can be as high as 6 or 7 years. So typically when you are buying a long duration bond fund or long duration fund, you actually are exposing yourselves to the vagaries of the interest rate economy a lot more than what you should. So and if you look at the long term returns of a short term fund, short to medium term fund, a medium term fund, and compare that to a long term fund, you would realize that the alpha or the excess return that these funds generate over a long period of time may not be worth the risk that you may be taking in the short run, because the interest in the economy are not static, they are dynamic. So it's far better to stay towards shorter in your yield curve for your extremely short-term investments, like less than 1 year, less than 6 months, and don't go beyond short-term to medium-term duration funds for your short to medium to long-term goals as well. As I said, focus on earning returns from equity rather than actually earning returns from debt. That is about giving you some kind of returns which can be protecting your purchasing power and giving you probably a real return of maybe 0.5 0.5%, maybe 1% over inflation, than actually expecting that job to be done by debt funds from. And credit risk funds and long duration bond funds have more risk, in our opinion, than the return potentials that they claim.
Thank you, Santosh, for pointing that out. And pleasure speaking with you. We've had, I think, a fruitful conversation. I hope our viewers have found it so.
Thanks.